Netflix has ripped 14% after reporting their Q3 numbers just a moment ago, which has many investors now wondering if the bottom has now been put in for Netflix and if this is the time to start picking up shares while the stock is down about 70% from those all-time highs back in 2021. We know they're involved with the streaming wars. They have a market cap now of $107 billion, a PE of 21. So is this the time to buy now that we're about 33% off those July lows? Well, we'll answer all of those questions and more on today's episode as we take an in-depth look into Netflix's Q3 earnings results. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we will be starting with the full business overview, jumping into the financials, the top line, bottom line, balance sheet, cash flows. And then we'll finally conclude with an evaluation of this business using our intrinsic value calculator, which is seen on screen currently. And this will identify whether or not Netflix is a value investment. And if you enjoy the analysis and the value investing perspective, please leave a like and subscribe because it means a lot to the channel. With that being said, let's jump into the analysis. All right, so as always, we'll start with the CEO and executive comments here. And they start off by letting you know revenue, operating income, and memberships all slightly exceeded their forecast for their Q3 2022 with big hits across TV and film. I'm sure many of you participated in watching some of these series and films here. And they also launched a lower priced ad supported plan in 12 countries in an attempt to add in and bring in more subscribers. They also go on to mention that they have more engagement than their competitors here with about 2.3 times Amazon's engagement and then 2.7 times Disney's engagement, at least in the UK. In the US, it's about 2.6 times Amazon's engagement and 1.4 times Disney and Hulu's engagement. Additionally, they go on to say that while their competitors are investing heavily to drive subscribers and engagement, the streaming business is hard and that they estimate that their competitors will have losses this year versus Netflix's annual operating profit of about 5 to 6 billion, which they estimate. That they're looking to reaccelerate growth, and it's clear that they've been able to do this year over year over year. If we look at this from a historical timeline, as we as value investors have to, they have been able to grow revenues year over year consistently despite the economic challenges we've seen since 2019, and even net income was able to benefit from this. But the question is, with Netflix and with the streaming wars going on, with more and more businesses coming into this space, will they be able to continue to produce at the rate that they are? Because at the end of the day, this business is heavily dependent on their strategy here, which is innovation, content, and growing the business internationally. I think Netflix will do well as long as they can improve their content and continue to have users watching their content and their Netflix originals. And the reason why I believe that is because if we look at the share of US TV viewing, they have about 1.3 trillion minutes viewed. And when we compare that to their main streaming competitors down here, we can see their competition has a long way to go to catch up to Netflix, or at least when it comes to taking market share away from them. But with Netflix, again, we have to keep in mind they have to spend exorbitant amounts of cash every single year in, year out, in order to produce the content that everyone desires, and they need to be able to perform day in and day out. Otherwise, you're going to go to their competitors. And as you can see, since 2014, this figure was growing, the amount of cash that they had to produce their Netflix originals and such. But since 2019, we have seen a decline here, which is good, and will keep more money in the business. But this has always been their strategy. As they said, the largest amount of cash content spent has already been made here up until 2019, and now they plan for going forward. They're looking to spend less and less on content, which is likely another reason why the stock is up 14% after hours. Now, let's quickly walk through top and bottom line. They came in with revenue of $7.9 billion. If we look at this over the last year or so, we can see they've been in and around that range for the past little while, and it led to 5.9% growth year over year. Okay, after we deduct for marketing, SG&A, etc., we're left with $1.5 billion in operating income and $1.4 billion in profits. Now, they lost about 4% in operating margin year over year, so that doesn't look great, but the management actually says the 4% decline year over year is almost entirely due to the appreciation in the US dollar versus other currencies, so that's important to note. On top of that, they've had 4.5% year over year growth in global streaming paid memberships, which is lower than what they've historically been able to do on a year over year basis, but they did just recently increase memberships, and so they said in their last earnings report that they were expecting to lose some subscribers here, and eventually, as the content cycle matures, more subscribers will be added on later in the year. Okay, if we quickly look at this from a balance sheet perspective, $6.1 billion in cash, $32 billion in content assets, so it's kind of hard to evaluate that, but altogether $47 billion in total assets, $13.8 billion in debt. So yes, more debt than cash. They're aiming towards getting this number down towards $10 billion, but nothing necessarily wrong with the balance sheet here. Then we finally get to our statement of cash flows here, bring down our 3 months ended net income figure of $1.3 $3 billion. After adding in all our non-cash costs, we're left with $500 million in cash from operations. Deduct our $85 million in capex, so we're left with about $470 million in free cash flow for this quarter. What are they doing with it to reward shareholders? Well, actually, they're just diluting shareholders a bit here and adding shares to the pool. Now, analysts are expecting that by the end of the year, they'll come out with about $10.30 in EPS. So if we plug that into our calculator here, and we expect that with a 10% return, they don't currently pay a dividend, that they can grow at rates of 8 to 10% for the next 5 to 10 years. On a 20 PE, they would be trading at about $174 for a safe investment. They're currently trading at $270 actually, now that they're up 14% after hours. Now, in the best case scenario, and we're actually able to take off from these levels, their estimations on their competition losing money comes to fruition. They take more of the market share. They're able to grow at 15% for the first 5 years. Then that drops down to about 9% for the 5 to 10 years. After that, on a 25 PE, the stock will be worth about $310 per share. So yeah, some nice upside from where we are currently. And then finally, in the very worst case scenario, let's assume they stop producing Netflix originals that actually capture audience's attention. They spend less on content. Things go worse for them. They're only able to grow at about 3% for the first 5 years and then 0% for the 5 years after that on a 20 PE. Yeah, they'd be worth about $100 per share. The stock would be slashed, and that's really what the risk and reward is for Netflix. We've already seen that when the growth does slow, the stock will tank. But if they really do make good on their promises and the competition actually does struggle as they anticipate, this stock should appreciate. And as we can see, we're already up towards $275 per share. So if this rally here can start to gain some momentum, we might actually see this stock all the way back into, $400 per share once again. If not, we'll see more of the same from Netflix, and the stock will be back down towards $200 in no time. But that is the risk and reward analysis for Netflix. If you made it this far into the video, please leave a like and subscribe, and I'll catch you on the next one.